Ever feel like you're drowning in financial advice? Like everyone's got a hot stock tip or a can't-miss strategy?
It's overwhelming, right? So much noise, so little clarity.
Exactly. And that's why today we're diving deep into a book that cuts through all that. Richer, Wiser, Happier by William Green.
Yeah, it's not just another get-rich-quick scheme. It's about the long game, about the minds of some of the most successful investors out there.
We're talking legends here, people who've not only mastered the markets, but also, like the title says, figured out how to win at life too. Think of this as your cheat sheet to their wisdom.
Exactly. Green sat down with these giants, picked their brains, and distilled their insights into actionable principles.
So today we're going to unpack those principles. We're talking the psychology of wealth, the decision-making frameworks these investors use, the crucial role of long-term thinking, how they navigate risk, and yeah, even luck, and so much more.
It's about going beyond just stock picks and getting into the mindset that drives success.
Becoming truly well-informed, as Green puts it. So let's jump right in. One of the things that really struck me in Richer, Wiser, Happier was the emphasis on the psychological side of investing.
Oh, absolutely. It's not just about crunching numbers. It's about understanding your own mind.
Right, and the book really drives home this point through the story of Sir Judge Templeton.
Templeton, yeah, a true pioneer in the world of global investing. He was adamant that our emotions, especially fear and greed, are often our worst enemies when it comes to making sound financial decisions.
It's that classic saying, investors' biggest problem and their worst enemy is likely to be themselves. It's so easy to get caught up in the hype or panic when the markets are volatile.
Exactly. And Templeton was very specific about the dangers of excessive optimism when things are going well. That's when you get complacent, start taking bigger risks without really thinking them through.
Kind of like when you're on a winning streak at the casino, and suddenly you feel invincible.
Exactly. And then on the flip side, when losses start piling up, the urge to panic and sell everything can be overwhelming. But Templeton and many of the other investors' green profiles, they've learned to recognize these emotional patterns and counteract them.
So it's not about suppressing emotions entirely. It's more about being aware of them and not letting them dictate your actions.
Right. It's about having the discipline to stick to a well-thought-out plan, even when your gut is screaming at you to do something else. This ties into the whole idea of rational decision-making, which is a recurring theme in Richer, Wiser, Happier.
Okay, so less gut feeling, more calculated moves. The book dives into some really interesting approaches to decision-making. One that caught my eye was Mohnish Pabrai's concept of cloning.
Ah, yes, cloning. Now, before anyone gets any crazy ideas, this isn't about genetically replicating Warren Buffett or anything.
Right, no test tubes involved.
It's more about taking inspiration from the best. Pabrai's idea is to study investors with exceptional track records, guys who've consistently beaten the market over the long term, figure out what they do, understand their philosophy, their process, their decision-making frameworks.
So it's like the reverse engineering success.
Exactly. And then you take those lessons, those principles, and adapt them to your own style, your own circle of competence, as Pabrai calls it.
The circle of competence, that's a key concept. Essentially, stick to what you know.
Right. Don't stray outside your area of expertise. If you don't understand a business or an industry, don't invest in it, no matter how tempting it seems. And Richer, Wiser, Happier goes into detail on some of Pabrai's other core principles,
Right.
like demanding a margin of safety. Think of it like a buffer, a cushion against the unexpected. If you think a company's worth $100 per share, don't buy it unless you can get it for significantly less, say $70. That $30 difference is your margin of safety.
So you're basically buying a dollar for 70 cents.
Exactly, and that protects you from the inevitable mistakes that everyone makes, even the best investors. Another key principle is focusing on quality. Don't just chase cheap stocks. Look for businesses with strong fundamentals, competitive advantages that are hard to replicate, things like that.
So quality over cheapness, that seems to be a common thread among a lot of these investors.
It is. It's about looking for value, not just low prices. Now, another investor green profiles who has a lot to say about decision-making is Howard Marks.
Oh yeah, Marx. He's big on realism and understanding risk, right?
Huge on it. He's got this great quote, "Experience is what you got when you didn't get what you wanted."
Ouch. But also, so true. We learn the most from our mistakes.
Absolutely. And Marx emphasizes that the best investors are those who are honest about their limitations, about what they don't know. He's also big on focusing on less efficient markets.
Less efficient meaning.
Meaning markets where information isn't instantly reflected in prices, where there's a greater chance of finding mispricings, undervalued assets. And his core question when evaluating any investment is beautifully simple. Is it cheap?
Is it cheap? I mean, it sounds almost too obvious.
Right. But it's more nuanced than it sounds. It says cheap in Mark's world means more than just a low sticker price. It means buying something for significantly less than its intrinsic value, taking into account all the risks and future potential that others might be missing.
So it's about understanding value, not just price. And it sounds like Marx is also very aware of the role of risk.
Oh, absolutely. He's all about managing risk intelligently. He doesn't believe in trying to avoid it altogether because that can often limit your upside.
You have to take some risk to get some reward, right?
Exactly. But it's about being smart about it, understanding the risk you're taking and making sure you're compensated for them. And Marx, like Templeton, acknowledges that you can't predict the future with 100% certainty.
Which is why we need that margin of safety.
Right, because no matter how good your analysis is, there's always the chance that something unexpected will happen.
Speaking of the unexpected, the book also delves into the interplay of luck and risk. That's a topic that's always up for debate in the investing world.
For sure. Some people think it's all skill, others think it's all luck. Richer, wiser, happier takes a more balanced approach.
As in,
As in, acknowledging that luck definitely plays a role. But the book also highlights that the investors who succeed over the long term tend to share certain traits that help them mitigate risk and capitalize on opportunities, even those that might seem lucky in hindsight.
so it's not just about being in the right place at the right time, it's about being prepared for when those moments arrive.
Exactly. And the book outlines what it calls the 5 rules of resilience, which are basically principles for navigating risk and uncertainty.
Okay, hit me with those rules.
All right, here we go. Rule number 1. Respect the inherent uncertainty of the future.
In other words, expect the unexpected.
Exactly. Rule number 2. Reduce excessive debt and leverage.
Don't gamble more than you can afford to lose.
Precisely. Rule number 3. Prioritize avoiding catastrophic losses over chasing short-term gains.
Slow and steady wins the race, right?
Yep. Rule number 4. Be constantly wary of overconfidence, both in yourself and in the market.
Humility is key.
It is. And finally, rule number 5, always demand a margin of safety. We talked about that earlier.
Right, the buffer against mistakes and unforeseen events.
Exactly. So those are the 5 rules of resilience.
Got it. Now, another principle that pops up repeatedly in Richer, Wiser, Happier is the importance of investing in what you understand.
The circle of competence, right?
Exactly. Both Pabrai and Templeton stress this point. Why is it so crucial?
Because when you genuinely understand a business, its products, its market, its competitive landscape, you're in a much better position to assess its true value and make informed decisions.
You're not just relying on someone else's opinion or getting swept up in the hype.
Exactly. Investing in areas you don't understand is basically speculating. It's gambling, not investing.
And as Templeton put it, it's a recipe for serious mistakes born out of ignorance.
Right. This also ties into the whole idea of simplifying your investment strategy, which is something a lot of these successful investors advocate for.
Keep it simple, focus on what you know.
Exactly. Joel Greenblatt is a great example of this. His approach is very clear. Understand the value of a business and buy it when you can get it for less.
Easy to say, harder to do.
True. But the discipline to stick to a sound strategy, even when everyone else is panicking or chasing the next hot thing, is what separates the winners from the losers.
Now, the subtitle of Richer, Wiser, Happier is How the World's Greatest Investors Win in Markets and Life.
Right. It's not just about making money.
Exactly. So what does the book have to say about building a balanced life? About finding happiness beyond financial success?
Well, there's this great quote from Ed Thorp, who made a fortune beating casinos at their own game and later became a very successful investor. He said, "Be decent, be fair, don't do harm to others, think long-term, and get the facts straight."
Solid advice for life in general.
It is, and it speaks to the idea that true success is about more than just money. It's about living a life of integrity, building meaningful relationships, and maybe even making a positive impact on the world.
And the book suggests that these successful investors, while driven and ambitious, often have a sense of perspective that goes beyond just accumulating wealth.
Yeah, they understand that money is a tool, a means to an end. It's not the end itself.
So financial success without purpose is kind of empty.
Right. And the book profiles a whole bunch of other investors who offer valuable lessons. Will Danoff, for instance, believes that stocks follow earnings. Meaning that in the long run, the price of a stock will reflect the earnings of the underlying business. So he focuses on finding businesses with strong earnings growth potential, what he calls best-of-breed companies.
Makes sense. And what about Tom Gaynor? What's his big takeaway?
Gaynor's a big believer in the power of compounding, of making small, incremental improvements over time. He focuses on companies that have a track record of profitability, strong management teams, and opportunities to reinvest their earnings at high rates of return.
It's that classic snowball effect. Start small, stay consistent, and let it grow.
Exactly. And then there's Paul Lancis, who emphasizes the importance of continuous learning and adaptation.
Never stop learning. The markets are constantly evolving, and you have to keep up.
Exactly. And Laura Geritz talks about the power of building an informational advantage. She does deep research, talks to experts, visits companies, all in an effort to understand things that other investors might be missing.
It's about doing the homework.
Exactly. And then there's Charlie Munger, Warren Buffett's longtime partner. He's a huge advocate for independent thinking.
Munger, yeah. He's got that great line, invert, always invert.
Right. He encourages people to look at problems from different angles, to consider the opposite of what they believe to be true. It's a way of challenging your own assumptions and avoiding blind spots.
So it's about thinking for yourself, not just following the crowd.
Exactly. And John Templeton echoed this sentiment when he warned against chasing fads. It's about forming your own opinions based on careful analysis and sound reasoning.
So if we had to boil all this down, what are some of the common financial pitfalls that Richer, Wiser, Happier warns us against?
Well, we've touched on a lot of them already. Emotional decision-making is a big one. Fear and greed can lead to all sorts of bad choices.
Like selling low and buying high.
Exactly. Then there's the danger of investing in things you don't understand, relying on other people's opinions without doing your own due diligence.
Right, trust but verify.
Exactly. And Templeton was a big believer in the importance of diversification, of not putting all your eggs in one basket.
Spreading the risk.
Yes. And finally, there's the critical importance of always questioning the price you're paying for an investment. No matter how good a business is, if you overpay, you're going to limit your returns.
Value is key. Okay, so we've covered a lot of ground here. But let's circle back to that subtitle. Win in markets and life.
Right. It's not just about money.
How does all this wisdom, all these insights from the world's greatest investors help us navigate that complex relationship between money and happiness?
Well, the book suggests that while financial success can certainly contribute to happiness, it's not the only factor. And in fact, focusing too much on money can actually backfire.
Yeah, money can't buy happiness, as they say.
Exactly. But the book also suggests that the disciplined, long-term approach that these successful investors take can lead to greater financial security, which can in turn reduce stress and anxiety and create more space for happiness in other areas of life.
It's about finding that balance, right?
Right. It's about using money as a tool to create the life you want, not letting it become the thing that defines you.
And the book even suggests that mutual funds can be a good way for individual investors to adopt these principles, especially those who might not have the time or expertise to manage their own portfolios.
Yeah, mutual funds can offer a way to diversify your investments, reduce risk, and benefit from professional management. Of course, not all mutual funds are created equal.
Right, you have to do your research and choose wisely.
Absolutely.
So as we wrap up our deep dive into Richer, Wiser, Happier, what are the key takeaways you think our listeners should really remember?
Well, I think it all comes back to those core principles we've been talking about. Mastering your emotions, making rational decisions based on understanding and value, thinking long-term, managing risk intelligently, never stop learning, thinking for yourself, and striving for a balanced life.
It's about becoming a well-informed investor, both in terms of the markets and in terms of yourself.
Exactly.
And on that note, I'd like to leave our listeners with a question. Which of these principles resonates most strongly with you? And what concrete steps can you take to start implementing them in your own financial life?
The journey to richer, wiser, happier begins with a single step.
Well said. Thanks for joining us on this deep dive. We hope you found it valuable. Until next time, keep learning, keep growing, and keep investing in yourself.